Welcome to episode 4 of the NRI Money Podcast. I am Sachin Mandot, your host, and I have Ritesh Jain with me. Ritesh is the founder of NRIZEN, Pine Tree Macro, and is a veteran of Indian mutual fund industry. He has been CIO of multiple companies. You can go to his LinkedIn and check, Time won't be enough to talk about that. So, in today's podcast episode, we are going to talk about nuances of different type of funds, active, passive, index, and what kind of investor should invest in what kind of funds. So, welcome everyone to the episode and welcome Ritesh.
Thank you. Welcome, everybody.
So, Ritesh, I'll ask a very grounds up question. So,
Yeah.
when you talk about investing, then there are a lot of jargon around funds. There are equity, bonds, active, passive, dynamic allocation funds, and there are now thematic funds as well. So, what are the
Mm.
differences in them?
So, although there are so many subcategories under bonds, equities, hybrid funds, but let's focus only on these four, these categories to start with, which you have mentioned. Others, which we can take it at a later stage, but let's start with the basic. So,
Yeah.
bond funds invest in the debt of a company or
Okay.
government. The ones which invest in government bonds are considered safer. Obviously, government has the capacity to print money to, and they never default. Okay. So, so these are much more safer than the ones which invest in companies' bond. The price of bonds fluctuate. So value of your funds fluctuate on a daily basis. Equity funds invest in the equity ownership of the companies. So when you invest in equity funds, you are actually owning a share of the company through your mutual fund. Now, equity is more volatile and risky than bonds, but then so are rewards of investing in the mutual funds, which can invest in companies which create wealth over a period of time. So
Okay.
whether it is bond funds, equity funds, or hybrid funds, you can choose to invest in growth plans or dividend plans, but that is a discussion for separate time. Now let's come to two different kind of funds. One is the active funds and what is the passive funds. Now,
So they
active
both
funds are
are
managed.
a sub-classification of equity funds. Active and passive are sub-classification of equity funds.
It can be bond funds
It
also.
can be bond as well. Okay.
Yes, it can be bond fund also. So I will explain the difference over here.
Okay.
Active funds are managed by fund managers. So there is actually a person behind it. Okay. It is
Okay.
managed by a fund manager who decides which companies to invest on your behalf. So basically, you are betting on the ability of the person to build wealth for you over a period of time. You should invest in those active funds which can beat passive funds over a period of time. Which brings us to the next one, which is what is passive funds or index funds?
Yeah.
Passive funds just replicate a benchmark. Uh,
Okay.
I'll give you an example. For example, if I'm sure you just have heard of Nifty Index or
Yes.
BSC Sensex, right? Now, there are many passive funds which just track Nifty Index, and when they get money to invest, they just buy the stocks in Nifty 50 Index as per their weight in the benchmark. There are many different kind of benchmarks. Hence, there are many passive funds which track these different benchmarks. One big advantage of passive funds is their fees, which is lower as compared to active funds. Now, there is one category of passive fund which is gathering momentum globally, and NRIs would have certainly heard about it. This is known as ETF, exchange traded fund. So I'm sure, Sachin, you would have also heard about
Yeah, because in this
ETFs,
part of
right?
the world, ETFs are the way to invest, right?
Exactly. So while you can choose passive funds only at the end of the day, like end of the day NAV, you can buy ETF like a stock at any time of the day using your stockbroking account. So you need to necessarily have a stockbroking account to buy ETFs. Today
Okay.
in Western world, ETFs have actually overtaken actively managed funds in popularity.
Okay. Uh, so, key takeaways. Equity investing is about investing in the growth of an economy through the companies that you're investing in from the
Yes.
whole discussion. And then there are some nuances to it. So now I'm coming to one question that I want to ask because I'm an NRI, and I keep I keep thinking on the asset allocation all the time. What should I do? And in Western world, we do a lot of passive investing. So what should an NRI choose, active or passive, both in India and in their home countries?
So it's a good question, and I will try to answer it, in a very simple way. I
Okay.
believe that if NRIs are investing in developed countries, let's call it G7 countries, okay,
Okay.
then they should consider passive funds. But if they're investing in developing country like India, then they should consider active funds. Now I will get into the reason why.
Okay.
Developed countries, by definition, are developed, right? That's why we call them developed countries, right?
Yeah.
They have low but predictable growth rates, right? In Canada, our growth rate is 1%, and it is there 1 or 2% for a long period of time, right? These countries normally have few winners across sectors with large barrier of entry for any new entrant. Think of it, we have, in every sector, we have two, three companies having 70-80% market share,
Yeah.
correct? We are not having
Absolutely.
any new winners now, right? Hence, the big continues to become bigger, and smaller companies are not able to scale up. In fact, smaller companies sell to the bigger companies. Okay.
Yeah.
All these large companies are already part of indexes. So by buying an index, you are already covering a large part of investment universe available to an investor. So think about it. When you are buying an index through passive or ETF, you are covering a major part of the market already.
Yeah.
The,
More or less every company, every major listed company is there.
yes. So and since few companies are, or have become very big, it's like an oligopoly. Developed countries have more oligopolists. Okay,
Yeah.
few companies, but they own the entire market. Now, developing countries, as the name suggests, are still developing, where growth rates are higher as compared to developed countries. Like India will be having a 7% GDP growth rate, Canada is having 1% GDP growth rate, right? Simple. So their growth rates are higher, and their regulations still do not favor large corporations. High and asymmetric growth and inflation allows new companies and new business models to come to the market fast, and they are
Okay.
able to create a niche for themselves. Hence, in developing countries like India, you should always look to invest, actively through actively managed fund, or what we call active funds.
Okay. So it is about in India when you say because of different reasons, the winners of the market, tomorrow's winners might not be in the indexes yet, or they might be somewhere which are not big, or their allocation might be small. So
Yes, exactly. So it allows, as I've explained, that the economy is growing very fast. When the economy grows fast, you actually have the space for new people to compete, become bigger. You have new sectors which open up. So you have niche companies which keep on coming up. Okay, they fight for market share. And an actively managed fund, the fund manager is on lookout for looking at these new winners. Hence, in a country like India, you should have some allocation or a large part of your allocation to actively managed
active.
funds.
So now the question: we know that active funds invest into companies that might not be a disproportionate part of the indexes yet, and they might be
Hmm.
tomorrow's winner. But then, how
Hmm.
do I choose an active fund?
Yes. So on NRIZEN, I have created a basket of funds for US Canadian investors and others also, other NRIs, based on changes I'm seeing in India. I'm only focused on flexi cap funds. What are flexi cap funds? These are the funds which can invest in small, medium, large companies based on fund manager's view, and they are not constrained by any view. So I'm actually giving it to the fund managers. You decide whether you want to invest in a small company, medium company, or a large company.
Okay.
The fund basket I've created is based on the following thinking process. As India's economic landscape evolves, a notable shift from service oriented economy to one emphasizing incremental manufacturing is emerging in India. So, this transition is heralding a redefinition of future winners within the market. Recognizing this paradigm shift, I've meticulously curated a fund basket tailored to capitalize on this changing economic structure. Uh, this selection strategically prioritizes investment with a heightened focus on the manufacturing ecosystem over service centric sectors. So I have created a basket of funds which I believe where the fund managers also are taking into account that the structure of Indian economy is changing, and they are actually going out and investing in tomorrow's winners. Okay, so I've taken this proactive approach, this acknowledges the potential for outsized return by aligning with the emerging trend shaping the Indian economy. And I started this thing in January. So we had our first quarter where we had the returns of this fund basket compared to the benchmark. So
Okay.
if you want, I'll just show you,
Yeah, please
this
do.
fund. Okay. So if you look at this particular slide, what you are
Okay.
able to see is the model one. Model one is I've not kept for you to know what is model one and model two. You have to register with NRIZEN and you will get these models. Model
Okay.
one is based on is basically made up of funds, a fund basket, which is for non-US and non-Canadian residents, basically for everybody actually. Okay. So in January, February, March, you have the returns of this particular uh, strategy, and you had the maximum drawdown. Now, if you look at on the right side, you will find how much did the benchmark did. Okay. If you see the Q1,
Yeah.
you see the return
Your
of
your fund did almost 8%. If I average out model 1 and model 2, you did 8%, whereas
yes,
Nifty 500 did 4%, 4.5. Nifty 50 is
yes,
only 2.9, mid cap is
yes,
4.18, and small cap is 2.19. So even if I
exactly.
average out of that, I am sitting somewhere at 3.5% max.
So exactly. So I have kept all the benchmarks for you. All these models are based on my quant, basically my thinking process. I've not used any, qualitative aspect in that. I've just used a very a quantitative. And through that quant, what came out is model one. If you would have invested in model one, your return in Q1 would have been 8.6%. If you would have invested in Nifty 500, your return would have been 4.42, Nifty 50, Nifty mid cap 150, and Nifty small cap. So you have it with you. Model 2 is US and Canada, and US and Canadian investors can invest only in a very small number of mutual funds
Specific
simply
number of
because
mutual
of a
funds.
yes. But there are enough. Like there are eight mutual funds which take that money. So if you see the basket return is 7.32. And even over there, you have almost done, almost double of Nifty 500, almost three times of Nifty 50.
Yeah.
So this tells you, although I am not going to say that, this proves that my basket is is doing far better than the benchmark, but it is a start. It's the first quarter of this particular uh, this basket, and during that first quarter itself, we had couple of times we had massive drawdowns in the market, but this
Okay.
basket stood its ground, and it delivered the returns far beating the benchmarks. So can you see this model one and model two is based up of actively managed fund? These are the fund managers managing your money. So if you would have invested in, again we coming back to active and passive, if you would have invested in Nifty 500 ETF or index fund, you would have made in first quarter 4.42% return. If you would have invested in the model one basket of actively managed funds, your first quarter return would have been 8.68%. This is just an example. This is just a number. These numbers can change in the future. So I'm just putting it in front of you.
But at least there's a win for one quarter. Let's take it quarter by quarter. But yeah,
Yes,
yeah, there's a win for one quarter at least. That
we
one
will
we start.
discuss this thing again in July. We will discuss again it in July. Every quarter, we will be updating the returns of our basket. Our basket will not change. Our basket will remain the same. But it's a good start. Let me put it this way. It's a good
Yeah.
start.
Register
Yeah.
on NRIZen, book an appointment with Ritesh. He has his Calendly link put in the YouTube description. He's there on Twitter, he's there on LinkedIn, or you can contact us even on comments here on YouTube. Thanks for listening to us. Stay tuned. We'll be back with fifth episode soon.
Thank you, everybody.